This one line on your chart tells you whether you should be buying, selling, or doing absolutely nothing. Today we're talking about moving averages. By the end of this video, you'll understand what they tell you about trend, momentum, and overall market direction without overcomplicating your charts. Now let's start simple. A moving average is just the average price over a certain number of candles plotted as a line. That's it. No magic, no prediction. For example, a 10 EMA averages the last 10 candles, a 20 EMA averages the last 20, a 50 EMA shows the medium-term trend, and the 200 EMA shows the long-term market direction. Different numbers, different time horizons, same idea. Now think of price as someone standing on an escalator. The moving average is the direction the escalator is moving. If price moves with the escalator, everything feels easier, momentum is on your side. If price tries to move against it, every step feels heavier and slower. So in simple terms, whether price is above or below a moving average gives us a quick sense of which side has momentum. Now that you understand why price behaves in a certain way around a moving average, let's talk about the big question. What does this line actually tell us? First, moving averages help us figure out trend direction. If price is spending most of its time above the moving average, that's usually a sign that buyers are in control. In this situation, traders usually stop trying to be heroes and short the markets and instead look for buying opportunities. Now let's flip it around. If price stays below the moving average for a long time, that tells us sellers are in control. And in this case, traders usually avoid buying and focus on sell setups instead. But then there's the third scenario, the annoying one. When price keeps moving above and below the moving average, back and forth like it can't make up its mind, that usually means the market is choppy or sideways. No clear winner, no clear direction, just pain. In these conditions, the moving average doesn't help much, and for many traders, the best trade is simply doing nothing and waiting until a clear trend develops. Yes, waiting is a strategy, and no, it's not easy. The second thing moving averages help us spot is a potential change in momentum. When price starts crossing above a moving average, it can be an early sign that momentum is turning bullish. Not a guarantee, just a heads up. When price starts crossing below a moving average, that can be an early sign that momentum is turning bearish. Basically, it's the markets quietly saying, hey, something's different. Next up is moving average crosses. This is why many traders use more than one moving average, like the 50 EMA and the 200 EMA. When the short-term moving average crosses above the longer one, it suggests short-term momentum is picking up and pushing price higher. When the short-term moving average crosses below the longer one, it suggests momentum may be shifting to the downside. These crosses don't mean price will instantly reverse and make you rich, but they do tell you that the market is changing and that it might be a good time to slow down and pay attention instead of blindly clicking buy or sell. If this is starting to click, that's pretty much what this channel is for. If you want more breakdowns like this, feel free to subscribe. No hype, just clear trading explanations. Now here's some quick setup before we look at examples. On TradingView, click the Indicators tab at the top, then search for Multiple EMAs by Salim Silva. I like this one because it lets you turn on up to 5 EMAs using single indicator. If you open the settings, you can choose which EMAs you want, adjust the length, and change the colors if you need to. For now, I'm just turning on the 200 EMA, and we'll use that for the examples coming up. Now let's look at this example. Here, price is clearly above the moving average, the blue line you see here. Notice what keeps happening. Every time price pulls back, it respects the moving average, then continues higher. That tells us something important. The moving average isn't acting as a buy signal. It's acting as dynamic supports, and more importantly, it tells us that the trend is healthy. Now, if someone wanted to trade this, here's a very simple way traders often think about it. Rather than chasing price, traders wait for a pullback towards the moving average, enter a buy, place the stop below the last swing low, and aim for a 1 to 2 risk to reward ratio. Next, in this example, price is spending most of its time below the moving average, the blue line you see here. Notice what happens whenever price tries to move higher. It pushes up, runs into the moving average, then gets rejected. That tells us sellers are in control. The moving average here isn't resistance because it's special. It's resistance because momentum is pointing down. If someone wanted to trade this type of markets, they wouldn't be looking for buys. Instead, traders often wait for price to pull back towards the moving average, then look for short opportunities. The buy stays bearish, invalidation is placed above the last swing high, and targets are set in the direction of the trend, often aiming for a simple 1 to 2 risk to reward. One important thing to watch out for here is fake outs. Sometimes price will briefly push above the moving average, making it look like the trend is changing, only to reverse quickly and continue lower. The key is to watch it closely when this happens. Once a price breaks out, it will often retest the breakout area. However, if it can't survive, then it's most likely a fake out and the trend will continue its course. Now for the last example, let's look at a sideways market. In this example, the moving average is running right through the middle of the price, and price keeps moving above and below it. There's no clear direction here, no strong trend, and in situations like this, the moving average doesn't give us much information. It's not acting as clean support, it's not acting as clean resistance, it's just telling us the market is neutral. This is where some traders stop using the moving average for direction and instead switch to support and resistance. If you map out the range, you can see its support is around $110 zone with resistance around $120. In a market like this, traders may look to buy near supports or sell near resistance, treating it as a range, not a trend. So in conclusion, moving averages aren't about finding perfect entries. They're about understanding context. When price is above the moving average, momentum tends to favor buyers. However, when price is below it, momentum tends to favor sellers. And when price keeps chopping around it, that's a sign to switch tools or slow down. If you can learn to read what kind of markets you're in first, everything else becomes much simpler. Thanks for watching, and I'll see you in the next one.